I think I messed up. Have you ever felt like this when trading stocks? It's a common feeling, especially when you don't fully understand the dynamics at play. But don't worry, we're here to break it down for you. Trading stocks can be a roller coaster of emotions, and it's easy to feel overwhelmed. However, by understanding key concepts like buying pressure and resistance, you can navigate the market with more confidence and less stress. Let me explain why stocks hit a ceiling and can't break through. This phenomenon is known as resistance, and it's a crucial concept in trading. Resistance levels can act as significant barriers that prevent stock prices from rising further, and understanding them can help you make more informed trading decisions. First, let's get some basics down. Understanding the fundamentals of buying and selling pressure is key to grasping the concept of resistance. These forces are the driving factors behind price movements in the stock market, and they play a critical role in determining the direction of a stock's price. Buying pressure means lots of people are buying a stock, pushing the price up. This usually happens when there's positive news or strong earnings reports. When investors are optimistic about a company's future, they are more likely to buy its stock, leading to increased buying pressure. Selling pressure, on the other hand, occurs when many people are selling a stock, causing the price to drop. This can be due to negative news, poor earnings, or broader market downturns. When investors lose confidence in a company's prospects, they are more likely to sell its stock, leading to increased selling pressure, is when lots of people are selling, pushing the price down. Now, what is resistance? It's a level where the stock price struggles to go higher. Resistance levels are often seen as psychological barriers where selling pressure outweighs buying pressure, preventing the price from rising further. Resistance is like a ceiling for a stock price. Imagine it as an invisible barrier that the stock price hits but can't seem to break through. This barrier is created by the collective actions of traders who are looking to sell at that price level. Imagine a stock struggling to go above a certain level, say $100. Every time it reaches this point, it gets pushed back down. This is because traders anticipate that the price won't go higher and start selling their shares, creating a resistance level. Sellers are waiting to sell at this price, traders take profits, and the market has turned down from this price in the past. This creates a psychological barrier. Traders remember these levels and act accordingly, reinforcing the resistance. And the market has turned down from this price in the past. This historical data reinforces the resistance level, making it harder for the stock to break through. Traders often look at past price movements to identify these key levels. So $100 becomes a resistance level. Let's visualize this. If a stock always falls when it hits $100, then $100 is the resistance. This level becomes a focal point for traders, influencing their buying and selling decisions. If a stock always falls when it hits $100, then $100 is the resistance. This is a critical point for traders to watch. Identifying resistance levels can help traders set their entry and exit points more effectively. Then $100 is the resistance. Traders often set their sell orders at this level, anticipating the price will drop again. This anticipation can create a self-fulfilling prophecy, where the price indeed falls due to the increased selling activity. So, what does buying pressure meets resistance mean? It's when the upward momentum of a stock meets the selling pressure at a resistance level. This clash between buyers and sellers can lead to significant price movements and trading opportunities. Buyers are pushing the price up, but once it hits a certain level like $100, sellers start selling heavily. This creates a tug-of-war between buyers and sellers. The outcome of this battle can determine the future direction of the stock price. But once it hits a certain level like $100, sellers start selling heavily. This selling pressure can overwhelm the buying pressure, causing the price to stall. When the selling pressure is too strong, the price may even reverse direction. This causes the price to stall or even reverse down from that level. Traders need to be aware of these levels to make informed decisions. Recognizing resistance levels can help traders avoid buying at the top and getting caught in a price reversal. You might see a long upper wick on candlestick charts, known as a shooting star. This indicates that the price went high but couldn't sustain it. The shooting star pattern is a visual representation of resistance in action, known as a shooting star. It shows the price went high but couldn't stay up, rejected at resistance. For a better understanding, let's touch on the opposite. Selling pressure meets support. Support levels are just as important as resistance levels in technical analysis. It shows the price went high but couldn't stay up, rejected at resistance. For a better understanding, let's touch on the opposite. Selling pressure meets support. Support levels act as a floor for the stock price, preventing it from falling further. Let's touch on the opposite. Selling pressure meets support. This is when the downward momentum of a stock meets buying pressure at a support level. Support levels are crucial for identifying potential entry points for buying stocks. Sellers push the price down, but it hits a support level where buyers step in. This support level acts as a floor, preventing the price from falling further. When the price reaches this level, buyers see it as an opportunity to buy at a lower price. But it hits a support level where buyers step in. This influx of buying pressure can cause the price to bounce back up. The support level holds, and the price starts to rise again. This causes the price to bounce up from that level. Support levels are crucial for traders to identify potential entry points. Recognizing these levels can help traders buy at the right time and maximize their profits. You might see a long, lower wick, like a hammer candle, showing the price dropped but got bought up again, rejected at support. The hammer candle is a strong indicator that the support level is holding. Showing the price dropped but got bought up again, rejected at support. This is a strong indicator that the support level is holding. Traders use these patterns to make informed decisions about when to buy and sell. In summary, buying pressure meets resistance, price goes up, gets rejected, and may reverse down. Selling pressure meets support, price goes down, gets rejected, and may bounce up. These concepts are fundamental to technical analysis. Understanding them can give you an edge in the market. Price goes up, gets rejected, and may reverse down. Selling pressure meets support, price goes down, gets rejected, and may bounce up. These concepts are fundamental to technical analysis. Recognizing these patterns can help you anticipate market movements and make better trading decisions. Price goes down, gets rejected, and may bounce up. Understanding these levels can help you make better trading decisions and avoid costly mistakes. By identifying resistance and support levels, you can set more accurate entry and exit points for your trades. Imagine a stock rising from $80 to $100. At $100, traders start selling because they think it won't go higher. This is a classic example of resistance in action. The $100 level acts as a psychological barrier where selling pressure outweighs buying pressure. At $100, traders start selling because they think it won't go higher. This selling pressure can cause the price to drop back down. The anticipation of a price drop at this level leads to increased selling activity. Even though new buyers come in, they can't overcome the selling pressure. This is why understanding resistance levels is so important. Recognizing these levels can help you avoid buying at the top and getting caught in a price reversal. They can't overcome the selling pressure. The stock price stalls, and traders who bought in at lower levels may start to panic sell. This panic selling can further drive the price down. Result: price falls back to $95 or lower. This is a clear example of buying pressure meeting resistance. Understanding these dynamics can help you make more informed trading decisions and avoid costly mistakes. That's buying pressure meeting resistance. Simple, right? Understanding these concepts can make you a more informed and successful trader. By recognizing resistance and support levels, you can better anticipate market movements and make more strategic trades. Hit that like button if this helped, and don't forget to subscribe for more trading tips and insights. Stay tuned for more videos that will help you become a better trader and navigate the stock market with confidence. Let's dive deeper into resistance levels. Sometimes a stock may face multiple resistance levels as it moves higher. For example, a stock might struggle at $100, then again at $110, and so on. Each of these levels represents a point where selling pressure could increase. Traders often set their sell orders at these resistance points, anticipating that the price will struggle to move higher. This creates a series of hurdles for the stock to overcome, making it challenging for the price to continue its upward trend. However, if the buying pressure is strong enough, the stock can break through these resistance levels. When this happens, it often leads to a significant price increase as traders rush to buy, fearing they might miss out on further gains. This is known as a breakout. A breakout occurs when the stock price moves above a resistance level with strong volume. Breakouts can signal the start of a new upward trend, providing traders with profitable opportunities. Now let's talk more about support levels. Just like resistance, support levels can also be multiple. A stock might find support at $90, then again at $85, and so on. Each of these levels represents a point where buying pressure could increase. Traders often set their buy orders at these support points, anticipating that the price will struggle to move lower. This creates a series of floors for the stock, making it challenging for the price to continue its downward trend. However, if the selling pressure is strong enough, the stock can break through these support levels. When this happens, it often leads to a significant price decrease as traders rush to sell, fearing further losses. This is known as a breakdown. A breakdown occurs when the stock price moves below a support level with strong volume. Breakdowns can signal the start of a new downward trend, providing traders with opportunities to short sell. Understanding the interplay between support and resistance levels is crucial for successful trading. By identifying these levels, traders can set more accurate entry and exit points, manage their risk better, and increase their chances of making profitable trades. Subscribe to Money Mindset with Proud Mary for more fun, informative tips. As always, keep learning. You too will master the market. Until next time, happy trading.